So walk me through what you are seeing in the market and what maybe you missed throughout the past month.
Well, I wouldn't say being more bullish at the bottom. The mea culpa was I didn't chase the rally after that Fed announcement on April 9th. I think we did a really good job of catching the panic low and then the relief rally turn. And if you remember on the show, we talked about how when the 14-week RSI gets as oversold as it was on the week ending March 20th, it suggested a 17% median rally, with the last three being 20%. So I think it's more fair to say that we caught the low right. We didn't chase that 20% rally, and now that it's up 33%. But again, I think it's important for people like me to say that we could miss a little bit. But I do have the same view. I think the market is still in this incredible relief rally that's now finally ended up playing catch-up in the Russell 2000 and some of the more economically sensitive sectors like the banks and the industrials.
What happened between that initial bounce, Tony, and the subsequent second leg that brought us to the 30% up off the lows? To your point here, you were basically waiting for more of a pullback to get even more bullish on stocks. So what's the marginal difference between that 15%?
You know, it really was the Fed-induced pickup in the corporate bond market, and I underestimated how traders would look at that as a great economic statement. So the Fed clearly has suggested that they're willing to buy even high-yield corporate debt that is downgraded because of the COVID-19 virus. And so many people wonder, how does the Fed and having liquidity end up in the stock market? Well, what happened is they haven't bought a single bond. And what they did is they backstopped the idea of risk so that companies are able now to come out and go into the markets and issue corporate debt. And I think what that's doing is the corporate debt market is saying companies are not going to, and back on April 9th, we called it a game-changing decision because it basically means companies are going to be able to stay in business with the economy shut down is when they can access the corporate debt market. Our reasoning, which is still the same, for why we're not chasing the rally is because the Treasury market, while the corporate debt market's telling you get to stay in business, the Treasury market is saying it's going to take an awful long time to begin to grow again.
Tony, with this idea that the Fed has been supporting the market, I have a little bit of trouble with it still, though. I mean, there's no doubt that this has been an important backstop. But the 10-year yield's gone nowhere since March 9th. It's actually higher, and the market's been higher since. So can we attribute the stock market purely to the Fed's actions when the old Fed model doesn't really apply? I mean, earnings yield minus Treasury yield, that hasn't changed because the Treasury's actually climbed.
Well, the Treasury yield is actually pretty flat. It's now at 59 basis points, so it's down below the 0.60 basis points. So it's where it was basically on the crash day, very, very close to it. The 210 yield curve is up a little bit from that point, but again, it's still historically flat. So the messaging is what makes an economy grow, Oliver, as you know, is banks become willing to lend even if the economic backdrop isn't great. And what gets them to be more willing to lend is, guess what? They make more money lending.
I want to continue to probe this nature of the explanation for stocks tied to the Fed, because the Fed's basically done a few things here. We know that they're not buying stocks. They said they were going to buy high yield but didn't, and they're actually buying treasuries. And the returns of all those asset classes basically move in the inverse direction. Stocks are up the most, then high yield, and then treasury bonds. So if this is all about a Fed put, that's kind of a weird Fed put where you go furthest away from where they're actually buying.
Right, but what it's indicative of is that the Fed is backstopping risk. So you got to think about if they're backstopping risk for companies in a weak economy. That's basically telling you that there are far too many people. If you remember how oversold it was during the panic phase, Oliver, I did a show with you where we talked about that it had seemed such a historic level of oversold that you were going to get this relief rally. I think a lot of people in funds were betting against that. So back in late March, when we're looking for the rally, there was an incredible short position, and then the short position got even bigger as you got that first leg of the rally. So the second leg of the rally has really caught a lot of people by surprise, again, me included, and that has led to this kind of surge. But it looks a lot more like a short covering, chasing performance than it does based on fundamental outlook, as we talked about with the U.S. Treasury yields.
Tony, we know that overall earnings are still declining, but where does the NASDAQ fit into this? What does the Fed have to do with Microsoft saying that they're unscathed, the biggest company in the world? The NASDAQ, is this not just basically 100 stocks stay-at-home trade?
It really seems like that. So what we found is everybody knows now that the top 5 capitalized stocks represent 20% of the market. So up until early this week, or very, very late last week, Oliver, if you equal weighted the S&P, it hadn't done anything, like literally zero. It was down at 0.75% on an equal weighted basis from that April 9th game-changing decision by the Fed to buy corporate debt, high-yield corporate debt. So again, it's really this ramp. What's been interesting is the most recent few days, going back to where you started, the ramp has been in the Russell 2000. It's been in the banks. It's been, I call it the banks and tanks. It's been in the financials and the banks and the industrial companies. It's an economically based statement that the market is making in a catch-up trade. And again, I think a lot of it has to do with we're not going to zero. The Fed has taken the worst case off the tape. It also doesn't mean that you're going to have a capital V economic recovery.
Tony, I just want to be clear here because I know there's folks who will listen and they'll say, okay, this is a big pumped up Ponzi scheme that the Fed has done more than they've ever done before, and now stocks are the most expensive they've been than at any point during the late bull market. Is that what you're saying, Tony, that the Fed has basically just put valuations back on the table? Or is there something real that stocks are sniffing out that other asset classes aren't about how bad this situation can be?
Well, I think we have to be careful because what has driven the large cap indices like the S&P 500 is 5 mega cap stocks. If you look underneath that surface, what has been improving in relative performance is the stocks that aren't that expensive, the more industrial-based stocks, the banking stocks, some of the tech stocks that aren't, in the big mega cap space. So you really have to differentiate, in my opinion, Oliver, between the S&P 500 now because of the influence of these mega cap stocks and what's happening on underneath. So our whole game plan was, and it remains, on weakness as we pull back, and someday we will. As we pull back, we want to see those sectors that are economically sensitive that have been outperforming lately continue to outperform as there's a pullback in some of the more defensive areas.
Tony, should those top 5 companies account for as much of the market cap as they do? Are we learning that they are, in fact, the ones that are most important to the future of productivity as we see working from home, so many of these stocks just accumulating more and more market cap? Because there's a lot of folks who look at that chart climbing and they say it needs to revert.
The market is filled with people trying to call absolute peaks in terms of when situations like this exist. Rather than try and bet that they're going to go down and revert, I would rather just say I'd focus on other areas that maybe aren't as expensive and haven't had the kind of parabolic move to highs like they have. Again, our whole message since we downgraded, the history is for the viewers. The history is we downgraded the market on January 20th. No, I didn't think it was going to go down 34% in 3 weeks, but we downgraded it because of a variety of risks that were around. Then we looked for a relief rally in a human nature-based thing, and we got the first leg of it right. The second leg of it, we've missed a little bit because it's been this short covering move. I want to become more sustainably offensive when I see the Treasury market indicating a growth outlook, not just a stay-in-business outlook. So we're, in this environment that we've never seen before after a huge, down 34% with a historic panic and oversold condition, I'll look past the fundamental outlook because you've historically always gotten a bounce. Up 33% from the low with a very clear, unclear fundamental outlook, I'm going to take a more hesitant approach.
Tony, do you want to buy on 5% dips, or do you have to wait for something big? Is this a pullback that could take us back down to the lows that you want to see? Just last question.
Oliver, I really think it's going to depend on how the U.S. Treasury market's guiding us. Is the yield curve steepening? I want to see the yield curve steepening because you want to see the Treasury markets giving banks incentive to lend for growth, not just lend because they have to keep companies in business.